Hello again, everybody. Well, I think a lot of us know what yogiisms are, right? They're those nonsensical, but admittedly sometimes brilliant one-liners uttered by the late, great Yankees Hall of Fame catcher Yogi Berra, who I think a lot of you know is also a St. Louis native. Here's a few of the most famous ones. I think you've probably heard of probably all of these. When you come to a fork in the road, take it. Then I think there's the most oftenly repeated one, and that is, it's deja vu all over again. How about this one? The future, it ain't what it used to be. And then there's my personal favorite, nobody goes to that restaurant anymore. It's too crowded. I mean, when you think about it, it's like, I kind of understand what he's trying to say. Like I said, somewhat nonsensical, goofy, they're yogiisms. But attach one of these guys to any of those same one-liners, and all of a sudden we look at them differently, don't we? It's like, whoa, that's so insightful. It's genius. Abraham Lincoln said that. Mark Twain said that. Here's one more. This is one from Yogi. It's kind of a little bit of a word salad. And it says, nothing is like it seems, but everything is exactly like it is. I mean, kind of a twisted mess, right? But if Abraham Lincoln said it, again, we would say, wow, that's so deep. What a great wordsmith he is. I'm going to give you one more, and this is the one that we're going to take to the end. Yes, there is a reason why I'm showing you these lines and the people behind them, because this one is something that I actually use every day. And you should too. Especially as you think about investing and especially as you do some of your research. And it goes like this. There are three kinds of lies. Lies, damned lies, sorry for the potty mouth, and statistics. Now, if Yogi Berra had said it, we might giggle and laugh a little bit. Oh, that Yogi, I kind of think I know what he's saying, but Yogi didn't say it. Mark Twain said it. Well, maybe. There's some historical debate about that. Some people actually point to the 19th century British Prime Minister Benjamin Disraeli. See the kind of information you get on this podcast? Did you even know that? Yeah, Disraeli was initially credited with that great line, but it doesn't matter whether it was Twain, Disraeli, Martin Luther King. Those words really mean something. Lies, damn lies, and statistics, because in today's world, when we look at things, especially on the internet, or we hear them on some kind of satellite radio or a podcast, maybe technically what we're getting information from is true. The statistics are right, but there's a story behind the story. And once we dig a little deeper, we realize that that's not really the intent. Let me give you an example of that. We've heard a lot today about how technology stocks are overvalued. It reminds us of the top of the internet bubble back in 99 or 2000. Personally, I'm not suggesting that. I'm just saying that seems to be a common theme among a lot of investors right now. And they look at the percentage that tech stocks make of the S&P 500. And they look at that data and they apply it to the past and say, you know, the last time we ever saw the tech industry in terms of the market capitalization this high of the S&P, the last time we've ever seen it, things did not go well for investors. You better wake up. What are they talking about? Let's put up this chart and I'll show you exactly what they're talking about. We're going back 100 years here. Notice that first little bubble where the red circle is. That signifies the top of the market in the early 70s, the so-called Nifty 50 bear market. The S&P 500 fell nearly 50%. So it's important to remember that trend line that you're seeing is not the S&P 500 itself. That's just the percentage, historically on a relative basis, that tech stocks make up of the broader market led by the S&P 500. The market, it did indeed really crash, cut in half almost after that first little red circle. Now we'll go back to the chart. Look at the second red circle. We are a little bit more familiar with that just in the last generation when the internet bubble burst and the market fell more than 50%. But now look at the far right of that chart, folks. That is us today. Again, we get to the fact that statistics tell us, uh-oh, look out, the last time we were ever at these levels and now we're higher than ever, it may not bode well for us. Now, I'm not suggesting it's lies and damned lies now. What I am suggesting is let's dig a little deeper beneath the surface. All right, folks? So let me ask you a question. Do you think that we live in a more of a technology world today than we've ever lived in the past? It's not a trick question. The answer is, of course, yes. Let me prove that to you. Let's go back to 1975. These are your largest companies in the U.S. They're iconic U.S. brand names, right? Notice that the top 7 are either auto stocks or oil stocks. In fact, 11 of the top 25 are oil or auto stocks. There's really only one pure tech play in the top 25 names. Coming in there at number 9 is IBM. All right, so it's a different world, right? That was America of 1975. Now let's get a little bit closer to the more recent past. And we're going to look at 1995. Believe it or not, things haven't changed that much. Now, let me take you back for those of you who are newer investors. I was managing money, yes, even in 95. I'm showing my age. My wrinkles, I think, have given that secret away. So in 1995, even though we were becoming more of a technologically driven economy, the tech market, the tech stock market part of it, was not overwhelming the overall market. Let's take a look. This is 1995. These are your top stocks in terms of market capitalization in 1995. And notice at the very top, they're still not tech stocks. In fact, IBM is still barely in the top 10. Microsoft, a newer company there, wasn't around there in 75 as a publicly traded company. It's cracked it. But really, only 2 other companies are even there. You've got Motorola and Intel. So you only have 4 tech stocks. As we were starting one of the great transformations in the history of our U.S. economy, and that's this newfangled thing called the internet. Now, we're going to put back up those 1995 stocks, and we're going to add in now just 5 years later. That's the key here. Look at 2000. Wow, have things changed. Now we're getting into more of a tech-heavy market. We now have more tech stocks at the very top. By the way, this reminds me, as you look at those 2 graphs there side by side, 95 and 2000. You know the danger of investing in just a single stock? This was happening a lot back then. People were saying, wow, look at this Microsoft going way back up. Recently, I just did a podcast on single stock risk. I say that podcast and this one that I'm doing now are really joined at the hip. So if you haven't seen it, as soon as you're done with this one, go back and look at this because it's like 1A and 1B. This is the one that really ties in to that previous one on single stock risk, as you can see here. Okay, so why did I put those 2 things side by side here? It's to point out what happened in that previous chart that I showed, the bubble up here in 2000 when tech stocks became a larger percentage of the broader market, and then we had the crash. It's because we came out of nowhere. In 95, we still were not a tech-driven world yet. We still had a lot of iconic old manufacturing and consumer product names. 5 years later, everything had been switched over. It got to be a bubble. That's not what we're seeing today, my friends. And to prove it, one more set of data to show you here, statistics, that will show you the difference between 2020, I should say 2020, and 2025. Again, just a 5-year period. Take a look at this. Now, we're just showing the top 5 here, but it's very telling. There's really no difference. The top 5 names just 5 years ago, tech names. Today, 5 tech names. In fact, the names are the same except for the new upstart NVIDIA, which is just popped in there in the last year or 2. The one that dropped out was so-called Meta. Of course, that's Facebook, but it's number 6. So it really hasn't dropped that far. So you see what's happening now. It's obvious that the tech market part of the S&P 500 is going to be naturally larger. Now, I'm not trying to make the case that tech stocks are not overvalued. I'm not trying to make the case that some individual names probably are not deserving of a pullback or a correction. Very likely could be. That's not the point. I don't make that kind of prediction. What I am saying, My opinion, but with a lot of confidence, is this is not 1974 and 75, just as 73, 74 as the market went down. This is not the internet bubble or anything like that. Based on that first graph that I showed you, that somehow because tech stocks are a bigger percentage of the market, that we're set up for a crash because this is a tech world. It's only obvious that the tech sector of the S&P is a larger percentage, all right? So please keep that in mind. I do this all the time. When I do my regular research and I look at data and I look at statistics and I say, I'm not taking them at face value just yet. I am going to look beneath the surface and see if there's a reason why this headline was even written. And with that, I'll leave you with one more Yogi Berra quote. It's tough to make predictions, especially about the future. No truer words have been spoken. So yes, it was Yogi. It wasn't Mark Twain or FDR or Teddy Roosevelt, but Yogi got it right, and that is especially, I think, applicable to the world of investing. We don't know the future. Stop trying to figure it out. Just stay within your goals and objectives. Be reasonable in your allocation. Stay within your risk tolerance, and the rest will take care of itself. I hope that helps. Please remember to hit that subscribe button. Pass this along to anyone else you think might benefit from the information, and we'll talk to you again next time.